Hello again. This is David Moore, Equity Advantage with Bob Zink, Zink Realty Advisors. We've been talking about real estate, investment real estate, and we're now going to talk a little bit about DSTs. So it's sort of interesting the evolution of these fractional ownerships of real property, what's happened through the years. And we had the whole tenancy in common deal, which sort of got hijacked and blown up, and then everybody looks at it as a bad thing. Ticks are horrible, which I totally disagree with. It was the sponsors that were horrible, not the tick product itself, or not product, the tick structure that was the issue. But now we're primarily looking at DSTs, and I'm sure a lot of people, I speak on this every day, and I've got clients every day that are going through this process, but so many people have no idea what a DST is. So since it's your ballywick, why don't you explain to us briefly what a DST is and why somebody might be interested in one?
Sure. Thank you, David. Just a little bit of maybe history even further. When I started in real estate, it was the limited partnership. We put together limited partnerships where you have a general partner that did the work and 8, 10, 12 limited partners who were investors and kind of went along for the ride and the benefits.
So it's sort of like a husband and wife. The wife does everything and we all get the benefits?
Exactly.
Yeah. Got it.
And as long as you keep your mouth shut, it works.
Yes.
Which I haven't learned. But, so the limited partnership then went to the tenant in common. And you're right, the tenant in common properties or I guess properties that didn't work were a function of a bad operator, bad ownership, timing, but often the ownership that they were good at raising money, but they weren't good at operating property.
Yes.
And that's often the case is you got to find out if you've got a money raiser or a property operator and you really need both. And that's now evolved into the DST, which is, acronym for Delaware Statutory Trust, which is where it started, and the lawyers put it together because it's an easier vehicle to work and own real estate in, easier for the lenders, easier for the sponsor. But what we have is the ability to own large pieces of property, which there's lots of benefits to that, David. One is somebody else is looking after the real estate, so we don't have to be worrying about it when we'd rather be traveling or spending time with grandkids, skiing up in Canada. And also something that isn't mentioned too often is today if you and I go out and buy a fourplex, lots of people can buy that fourplex and the returns get compressed. There's not a great return today and certainly no cash flow. But we could take that same money and put it into a DST and have 5 to 6% starting cash flow that would grow over time. And then in addition, we of course would have appreciation, we would have debt reduction and get a return over 5, 6, 7 years up in the mid-teens. So you get, we can own part of a $35 million building as opposed to $1 million.
So are the DSTs, Bob, are they typically a single asset? Are they multiple assets? I mean, I a lot of times I'll describe a DST as a sort of a mini exchangeable REIT, for example.
Right.
And just to clarify things, I know we've discussed it before. You can exchange into certain REITs. There's something called an UPREIT that you can get into. But if you use that process, you're going to get in, you can't get out. You can't exchange out of that thing again. Where DST, you could exchange in and out. But
yes. They're both. That's the advantage of the DST market. There's DSTs that they own 2, 3, 4 properties, and there's some where you just own one. And the range of debt is all over the market. There's free and clear DSTs, and there's DSTs, the debt all the way up to 75, 80%.
So when we're looking at a 1031 that has a certain value and equity requirement, and keep in mind a lot of people look at a 1031 and they say, well, you have to replace debt in an exchange, and you don't. Debt can go away 2 ways, one by going down in value, the other by adding cash. So we're really primarily concerned with debt and equity. And you're telling me that you've got product, everything from, don't you have like a coupon clipper type thing, something that's got very little, if any, equity going in, but...
Yeah, there's coupon clippers that really have zero cash flow where they're dedicating all of the cash flow to paying off the debt, which will then cover those properties that we've gotten into for either leveraging them up or saving
somebody.
Yeah, saving somebody. But yeah, the DST market has been around now long enough that there's providers providing whatever kind of asset you need, multiple assets. But because they're a larger asset, you'll get a higher return than you and I would get buying a rental house or fourplex or even a 6 or 8plex in our present market.
Definitely. And they might have deeper pockets and a bad turn, too,
Deeper
to
pockets.
make it work.
There's DSTs that have been around now 20, 30 years, have a long history.
Nice.
Very deep pockets, and they're taking care of those tenants and toilets and trash and government regulations.
Definitely. Well, thank you for joining us today again. And this is once again David Moore, Equity Advantage with Robert Zink, Zink Realty Advisors. And we're talking about investment real estate, DSTs in particular. Thank you.
Thank you.